Hi, Joe Cantu here, and the eyes of the world are upon us. There's a run on the banks.
Welcome to Retirement Tactical Money Management. Joe Cantu, Chief Investment Officer of Cantu Tactical Wealth Management, is your host and has over 30 years of experience in the retirement money management profession. He is a West Point graduate with a master's in business administration and has worked for 3 of the largest Wall Street firms as a stockbroker and portfolio manager.
Hi, Joe Cantu here. The eyes of the world are upon us, and there's a run on the banks in the United States. And it might be happening worldwide. So I'm doing this podcast kind of to explain what's going on, what happened this last week, and then what happened this week. Today is March 15th, 2023. And I say the eyes of the world are upon us because if you take a look at the United States dollar, it represents many foreign countries' backup currency. Or their currency is backed by the U.S. dollar. And so, and in other countries, they use what's called a blended backup currency. And, it may be the British pound along with, the United States dollar and other currencies. But yet the United States dollar is a very big part of that. So everybody in the world, foreign countries, imagine that you're a businessman in France and you're looking at the United States to see what's going on and how we're handling this run on the banks, because a run on the banks has occurred. Now, if you remember the crash of 29, when that happened, it occurred because of a run on the banks. That means people moving their money. So that's why the world is watching how we are handling this, quote, reserve currency, to other countries where are the reserve currency, but our currency in the banking situation here in the United States. So let's get started and let me talk about kind of what happened last week. So in California, there was 2 major regional banks. Now, the big banks, I want you to know, are all set. They're fine. They have great currency, great deposits, and that's not an issue. But there were these 2 regional banks in California, and they have a lot of what's called VC capital. And VC's capital is venture capital. So they loan money to small new businesses, have a lot of high risk. We call it seed capital for them. And I guess that was drying up. They tried to raise capital on Monday. They couldn't raise it. And I guess by Wednesday they were insolvent. And so the 2 were insolvent on Wednesday. So what happened on Thursday is, and just to let you know, those of you who have a brokerage account here at TD Ameritrade, TD Ameritrade is not, I say here at TD, I'm not with TD Ameritrade, but there are custodians. And they, in fact, are not a bank. So this banking situation indirectly affects all financial institutions, but doesn't directly affect the brokerage institutions. So anyway, the term run on the banks is used when depositors pull money out, and in the old days they pull it out and put it in their mattress, is what they say. But in today's world, you pull it out of one institution and then move it to another institution. And if you're pulling it from the same types of institution, then we can say there's a run on the banks on, quote, in this case, regional banks and small banks. So the big banks they're fully intact and they're fully capitalized, and they're backed by the backed with the government, FDIC insurance, and again, they've done stress tests on the bigger banks. So the bigger banks weren't an issue. But for example, if you bank at a small bank or at a regional bank, that became a concern, because what happened is as money started leaving the smaller banks, because the regional banks across the country, business owners who have small to medium-sized businesses were seeing this and that it was an issue, so they started pulling their money out of these small to regional banks and pushing it to the bigger banks where their deposits were safer there. And their concern is they have to make payroll if you're running a business, and you have to make payroll on Friday. So that's kind of what was happening, and they were moving their money from the small banks to the safer, smaller local banks to the safer, larger banks, which had more sound financial stability. So this continued, and on Friday, what happened? So what I'm trying to say is, it just wasn't these two banks, and then the third bank collapsed actually, and I think it was in New York. I'm not 100% on that, but a third bank collapsed. So this was happening because of this run on the banks from people moving deposits from one small institution to a larger one. Let me give you an example. So let's say, and on Friday, what happened is some of the businesses actually couldn't make payroll. The banks didn't have the money to make payroll because they became insolvent. And that was in the morning by 12. So this was an emergency. So then the FDIC stepped up within a couple of hours, and then by 2 o'clock to 3 o'clock, they were making good on those deposits. And then many of the companies could make their payroll, and pay their employees on Friday because it was Friday. But this panicked everyone. And so it continued the run on the banks. And let me give you an example. Let's say at your local bank, where you bank at, they have, say, $50 million in loans outstanding. But say they have deposits of $60 million. Many of the banks, just run, right on that edge of becoming profitable. But then all of a sudden, they start, say, again, we're using the example of, say, your local bank or local small bank in your town or small regional bank or whatever it may be. And then people start panic, and they see these banks collapsing, the small regional banks, so they say, oh, we need to go to the big banks. So they pull their money out of that small bank at your town, and then they turn around and put it into a big bank who might be in your town as well. So they put in a big bank, which is much safer. But just that small action really affects that bank. So now all of a sudden they had 60 million in deposits, and they had 50 million in loans, and now maybe that gets pushed down to, say, 45 million in deposits, and they have 50 million in loans. They're upside down. They're insolvent. And that's kind of what was happening across the country. So this phenomenon that was happening across the United States with all banks. And here we are on Wednesday in this following week on the 15th today. This is still happening. There's still a run on the banks. Right now, there's still people moving assets from their small bank, if you bank locally, or small regional bank, and they're moving it to the big banks because of what happened. And again, you don't want to be one of those people who have more than, I don't know what the limit is, if it's 100,000 or 250, but so this was a concern last week, and if you have more than that, you just lose your money. It's just gone. It disappears. And that was a concern that was happening on Friday. So, and again, so then what happened, we were watching the volatility of the market, and there's a couple of little things that we watch, and one of them is called the VIX. But the VIX measures is a good measurement of what we call uncertainty in the market. And if the VIX number gets too high, and that number that we use is typically 30, if that number gets too high over 30, then we know that there's an uncertainty level, a disproportionate uncertainty level of too much risk. And this sets off an alarm, in our minds, because the VIX shouldn't be, too out of whack. And it's just an indication of uncertainty in the market. Well, when that went up, we knew so here we had, by history, a run on the banks. At the same time, we're having the VIX shoot up. So there's unbelievable amount of uncertainty in the market, so we had to take action. Now, what's interesting about that is this past weekend, the United States and the United States Federal Reserve and the Treasury Office of the United States, the banking regulators and members of Congress all had worked all Saturday and Sunday to try to unravel this situation of the bank failures. Because understand this, it just wasn't the two bank failures, it was a run on the banks that was occurring across the country. And again, if you remember what happened with the crash of 29, it happened because of run on the banks. They took the money out and banks collapsed. And and again, I'm a viewer of financial history, and I watch that a lot. And I remember the 2008 financial crisis. It was a lot of the same thing. Just people panic and they pull their money out. So if the Congress met, and then they passed, the regulators, bank regulators, they're all meeting this weekend. They worked all day Saturday, they worked all day Sunday. And again, I knew these meetings were taking place, and I knew that on Monday what I needed to do was just take our clients' assets out of the market. And so we had to do that. And we're not out of the market very long, maybe a week or week and a half or two, until this banking situation unravels. And now in today's society, with the information age, everybody moves very quickly and they put these things in place. But that's kind of what happened Sunday night, is those everything was in place. So Monday, the president came out and he said, Monday morning the president said that they were going to insure all assets, which led to a good Tuesday market. So so everything seems kind of fine and everything. But again, what's really still happening is there's a run on the banks worldwide, not just globally, which we were not aware of. We thought, again, primarily in the United States, and again, the world's eyes of the world is watching the United States and our government and how we're handling this run on the bank situation. Wednesday, which is today, and this really happened because of the time zone and everything. It's really happening like Tuesday night for us. But the Saudi National Bank went to borrow money, and of course, in the oil business, you're doing, you're getting loans for oil and gas equipment, leases. Pipeline leases, drilling leases, all kinds. But basically in the oil business, you get a lot of loans. You need to borrow money in order to do business. So the Saudi National Bank went to borrow money from Credit Suisse, which is one of the biggest banks in the world. And Credit Suisse said, hey, we can't loan you money anymore. Oh my word. So all of a sudden, what, are they insolvent too? I mean, is that a problem? So then the market went down 600 points this morning, and it was down pretty hard. And now what's crazy about that, since it was a Saudi bank and we're dealing with oil, this morning the energy industry stocks overall were down 7%, which is crazy. Sometimes they're down, 0.5%, a quarter. If they're down 1%, that's a lot. They're down 7%, 700 times their normal, what we normally expect, which is just outrageous. But luckily, midday today, which is in their time, is really at the end of the day, at the end of the business day, the Swiss government central bank, which is like our Fed in the United States, said they're going to come in and they're going to help the Credit Suisse bank, with their assets. And I don't know if they're going to cover them or bring in other people to help cover them. But again, now the eyes of the world have shifted, and now they're looking at Credit Suisse, because now we're talking about a global pandemic, could be, to use that word, in the financial markets. So, we don't want that really happening, but that is so significant because it could help the lending around the world in all businesses, but not just the energy business. So I guess in you understand now why this is so critical. Again, because I saw that it was a run on the banks, you just don't even want to be in the financial area, and that's why in our company's case, we went to cash pretty much across the board on every account, every customer with us. Now, we're not going to stay there very long, just until this clears up, which might be just about a week, week and a half, 2 weeks. you'll be able to tell the way the markets trade, whether they're down 300, 350, 400 is probably too much, or up 300, up 350, 3 to 400. Again, in a normal trading range, if things are like that normally, and they have been, that was good on Tuesday, and today it was bad, and so that was an alarm. But at the end of the day, it closed better. And then again, we're going to look at tomorrow, Thursday, and we're going to look at Friday. And if things are normal, now the other important thing to realize is that on Tuesday, I believe it's Tuesday, it's either Tuesday or Wednesday, but the Fed's going to meet. Now, what's interesting about the Fed is you notice that when the Fed has been raising interest rates, the market takes that as a negative, that there's going to be more bad news ahead, and they sell the market down. But now with this banking situation, some people are saying, well, did Fed Powell raise interest rates too fast, and it hurt the banks. Now, what do they mean by that? Well, again, I gave this analogy or this scenario about the fact that banks, they make money by making loans. So if you raise the interest rates, you can't make as many loans. So it hurts, the credit facilities, so to speak, the whole credit business, of course, it hurts housing and things like that. But if banks can't, granted, they make interest on your money, but again, that interest, they make more money on the loan part. But if interests go up too much, then it hurts them. So indirectly, there's many people in the financial business feels that they're putting a blame on Fed Chairman Powell, that indirectly that had to have some effect to hurt the banks as well. And again, the board, there's 12 Fed banks, but the board looking at this, they represent the people. They don't work for the government. The Fed works for us, the people. So they have to be looking at this, and that has to be a big concern for them. So now, before they thought, well, because inflation's not slowing down too much. The jobs numbers, for example, the jobs numbers are still coming in amazing, so they were talking about we're at the highest employment in 58 years in the United States. The best employment in 58 years in the United States. And, if some people are out of work, for every one job, they say there's 10 openings out there. There's so many people, so many openings for jobs, and some of the people don't want to work, but we're still at the very, very best employment. I remember one of the numbers, I don't know if it was payroll or what it was, they were expecting like 200,000 or 217. It came in at 500,000, and that just happened like a week ago. So again, you can't really say you're moving into recession when the fact that the job market is so strong. And Tesla had record sales. Royal Caribbean have record bookings. And there's many other, it's funny, we're in kind of an unusual society here in the United States, an unusual business climate where, there's some areas that are moving down, again, like housing, which is supposed to when you're slowing the economy down, but other areas that are super strong. And again, don't take my word for it. You be the tester. You go out to a restaurant. You go out to your area. Are the restaurants empty or are they full? Go to the airport. If you're flying somewhere, are they empty or are they full? Go to the grocery store. Go shopping, wherever. Are they empty or are they full? If we're going into recession, they're empty. If the economy's doing well, everything is full. Are the freeways empty? Are they full? Remember during COVID how the freeways were empty? Well, we don't see that now. So you be the guest of you take your own measure of how the economy's doing. But realistically, take a step back. No Democrat or Republican. You be the decision maker. You take a step back and you look at the business climate of America from your standpoint. Is it weak or is it strong? And then you decide, should you be in the market or should you be out of the market? Now we here at Cantu Tactical, we look at earnings numbers. And the earnings numbers are still coming in good. Some are slowing a little bit, they are, but overall, the earnings numbers are still very, very good for many of these companies. Walmart just had a spectacular release of earnings this past quarter, on its measurement, the report card, so to speak. So, that's what we look at. We actually look at the earnings number. The earnings numbers dictate to us if the market is good. And right now, the market and business climate is good. Caterpillar had good numbers. Deere, they had good record sales of tractors around the world, and they actually raised their outlook. China's coming out. They're raising, they're actually trying to market more around the world to bring manufacturing back to China because they opened up. And China is also one of the biggest users of energy. Now, just again, my opinion on China. Some people don't like China or whatever. My opinion is just the opposite. My opinion is the fact that the Chinese is one of the biggest global powers in the world. And you have the military side, and then you have the industrial side. But the industrial side, they like business. And again, many of our chips and a lot of technology before COVID was made in China. And then because of that, we've had to start creating manufacturing arenas here in the United States to duplicate that, only because that China was closed down. But now China's trying to bring that back up. And let me be frank. Let me just tell you one quick story about China. And I'm just going to say this and put it out there. But many of the buildings in many of the major cities, whatever city you live in, Houston, Dallas, Washington, Baltimore, San Francisco, Los Angeles, all the major cities, many of the buildings are owned by Chinese consortiums. Yeah, that's right. It's probably not an unfair statement to say maybe over half the buildings in some of these major cities here in the United States are owned by the Chinese. That you may find that shocking, but that's really true. And I'll tell you an interesting story. I became a baby broker back 33 years ago. It was 1988, and then in 1989, I remember during the savings and loan crisis. Now you got to understand this. In Texas, we had an oil debacle, and then it pushed into the savings and loan crisis. And then I remember one day working there, and the bond market was going down, 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 and it was a total collapse of the bond market in the United States. 10 minutes before the close, one country came in of investors, and they just started buying U.S. Treasuries, and then they propped the bond market up. In that 10 minutes, they saved the United States bond market from collapsing. And guess who that was? It was the Chinese. The Chinese came in and they bought United States Treasuries and prevented the collapse of the United States bond market on that one day. I'll never forget that to that day. Here I am, 33 years later, or 32 years later, and I remember that event like it happened yesterday. So then I asked one of the big brokers after the market closed, I says, so why did the Chinese do that? And he says, Joe, he goes, they have such a financial investment in the United States. He says, and I remember him at the time saying, he says, you may not know this, he says, but half the buildings in Houston, Texas are owned by the Chinese. I said, you got to be kidding me. He says, no. He says, they cannot afford for the bond market to collapse in the United States, the debt market. He says, because, mortgages are debt. And so the Chinese own a lot of the mortgages for many of the big, large buildings. But, and I'm sorry about that car I hear in the background honking. Anyway, so he said they can't afford that. So they bought treasuries. To them, the treasuries, U.S. treasuries, were cheap, and they knew they could make that money back. So that's what they did, and they propped up the United States treasury market that day. And so my view, of I guess foreign countries and the way they look at the United States is totally different. Now, my wife and I, we lived in in Europe for 4 years, and it's truly interesting to see the world living in a foreign country. And you can get into all kinds of areas about, they just don't let anybody into these countries. But I worked there for Europe in 4 years, and that's why my wife and I were there for 4 years. And then of course, being in the Army, I was in the military service, and I've visited foreign countries being in the military, and then I worked in Latin America for a while as well. But my point is that the world is one huge big economic pot, and we all kind of have to work together, to keep everything going on in this world. And so it's very important that we view the world like that, and especially on economics and business, we all, hopefully we support one another, and then it makes it a better world, and we can operate in our investments and go up, and retirement, and we can retire, and everything can stay safe and healthy. I do believe that within a week or so, that here in the United States, with this run on the bank, we're going to be out of the woods, and we'll move to clearer ground, and this will be over. And with our customers here at Cantu Tactical Wealth Management, we'll move back into the market. We'll probably tiptoe in, and then I say tiptoe in. We may start off with high yield corporate bonds, or move into the corporate bond market, and then slowly move back into equities. And because overall, I still believe that with the growth with the Fed raising interest rates and seeing the growth and the best employment that we've had in 58 years, that I believe that the market's going to go up in the United States. I've been saying that for a year and a half, and I know I sound that like a broken record, but I still believe that. And if the Fed was lowering interest rates, remember that. If the Fed was lowering interest rates, it would mean that the economy's in trouble, and the Fed lowers interest rates to jumpstart the economy. That's not what's happening. The Fed is raising interest rates. So because they're raising interest rates, I believe that the market's going to continue higher. Now, unfortunately, we have this hiccup. We have a run on the banks right now, which is not good, but I think it's slowing down. And if it was nice that you saw Switzerland again reinforce Credit Suisse, and maybe they're taking their movements from looking at the United States. They say, well, look at the move that the central bank made in the United States, which is the Fed and the Treasury Department. So we need to make the same moves over here, supporting our banks as well. And then so if Europe sees this, and in other countries, I think overall that it'll ease the market. In some ways, there is a possibility that this may actually jumpstart. It may actually jumpstart the markets, the equity markets. Maybe this is what the equity markets were looking for. They were looking for a sign, a signal of, quote, support, of extra support behind their financial backings. Many of the companies out there that have questionable debt, we call those junk bonds, 40% debt or more. All of a sudden, if they know that the central bank supports that and won't let that collapse, then that reassures them, and that brings life. And then investors see that, and so they say, hey, I think it's all right to go ahead and buy that stock. I think it's going to go higher. And it also helps other investors say, okay, well, yeah, we're going to go ahead and put our money into this bank, or give money to this smaller bank. And of course, they make loans on that, but it allows investors to speculate more, knowing that they're going to be supported by the central bank of their country. I'm not just the United States, but whatever country you're looking at, or living in. And so that's what's important to understand. And I think overall, watching the United States with this happen, and now watching Switzerland and with Credit Suisse, this happening, and then the Saudis watching it too, I think this helps the world. It helps the world economy. So I'm still bullish on the market. I know we have a run on the bank. Run on the bank is still occurring right now. I mean, there are people moving money from their small bank to their larger bank just for safety, but I think it will stop. And then I think the equity markets will be back on track. Well, that concludes my briefing. You can tell I'm passionate about what I believe and what I've seen, and I've seen so much over the years, and from I've seen the markets in wars. I've seen them in financial crisis, and many different types of financial crisis, and overall we learn from what we go through, and I think this will be corrected very, very quickly. And then again, I've told you what we're going to do here at Cantu Tactical. That concludes my podcast. I have some disclosures at the end that you can listen to. Have a good day.
Welcome to Retirement Tactical Money Management. Joe Cantu, Chief Investment Officer of Cantu Tactical Wealth Management, is your host and has over 30 years of experience in the retirement money management profession. He is a West Point graduate with a master's in business administration and has worked for 3 of the largest Wall Street firms as a stockbroker and portfolio manager. Over 10 years ago, he created Cantu Tactical Wealth Management, which actively balances and selects investments based on a tactical approach rather than the traditional strategic management method. Instead of the buy and hold philosophy, he believes in the pursuit of finding investments showing momentum, performance regardless of the direction of the market. His experience includes IRA accounts, 401k rollovers, trusts, endowments, defined benefit plans, 403bs, and 401k plans. Additionally, he served as a night college instructor for seniors, teaching high net worth retirement and estate planning for 14 years. Podcast views and personal opinions are for educational and entertainment purposes only and does not constitute a recommendation. Investing has risk of loss, and you should consult with your own advisors for any financial decisions. Cantu Tactical Wealth Management is a fiduciary, registered investment advisory firm in the states of California, Florida, Georgia, and Texas, providing pure independent advice and money management.